Ladies and gentlemen, welcome to the Santa Claus rally as I have predicted. Here on this channel, it seems to be occurring. Today is officially the first day of the Santa Claus rally. It extends from now into the second trading day of January on paper. Now, you also get something called the January effect that tends to just create a pretty good January, or at least the first couple of weeks of January tend to be pretty good. And that really has to do with tax loss harvesting, where a lot of hedge funds and institutions, they sell stocks to offset some of the gains that they have in other areas to lower their clients' taxable burden. We've seen this tax loss harvesting season that has been really rough. The RSP, the equal weight S&P, fell about 8% from high to low. And I think a lot of this has to do with tax loss harvesting against some of the gains in big tech. Now, we will discuss this a little bit later throughout this video, but I actually think that's kind of the catalyst for a broader market rally where some of that tax loss harvesting kind of goes away, obviously, to start January. And you see the rebuying effect of those tax loss harvested stocks, okay? People go out and buy those stocks back again because it's not like they are bearish on those names. They're just down on them. So they take the loss and then they buy them back later. And that's what tends to give you the January effect. Now, there's not as strong of a bull thesis for big tech next year as well. And I think that will ultimately be part of it. Now, the S&P 500 is up 0.89%, currently breaking above that $600 level on the SPY or 6,000 on the SPX. Now, this is a great sign for the first day of the Santa Claus rally. The Russell 2000 is also participating, up 0.72%, NASDAQ up 1%, again S&P up 0.85%, and the Dow is up 0.68%. You can also see the VIX is down about 10.5% today, which is also a good sign. After the VIX recently spiked as high as 28, now down to 15, that's more of a normal level. It is kind of on the high side, but more normal. Now, what happened today? We did get some data. First and foremost, we got a 30-year, a 30-year bond auction and a 5-year bond auction. And for the most part, they both came in good. It says here the win issued was 4.480% on this bond. This bond auction was worth $70 billion, so it was large. And the final yield came in at 4.478%. So a little bit lower than the win issued price. That just means there was a little bit more demand and yields came lower. That does have a positive impact to the entirety of the long duration yield curve. 10-year treasury yields are down now slightly on the day today after previously they were actually up today. Okay, they actually hit a high of almost 4.63%. Now they're at 4.597%. So they actually fell about 3 basis points following these bond auctions. So that is helping to really fuel the next leg of this market rally that we've seen today. Besides that, the Richmond Fed December Manufacturing Index rises to negative 10.0. The estimate was negative 10.0. Previous month was negative 14.0. This is the highest number since May of 2024. So a little bit of recovery in the manufacturing sector in the Richmond, Virginia area. As Ryan Dietrich points out on X, the S&P 500 is up about 25% this year with only an 8.5% peak to trough pullback all year, and that happened in August. He says, just remember, the average year sees a 14.2% correction, which increases the odds it might happen next year. So we are overdue for a correction, but I mean, there's a lot of reasons potentially to be excited next year. I think they're the reasons that are really out of consensus, okay? Like if these things happen, markets are going to do really well next year. First and foremost, if inflation comes down more than expected, that is kind of the upside scenario. Everyone kind of expects sticky inflation. They expect a super strong economy and good earnings. I could imagine a scenario where inflation comes down more than expected. The economy does good, earnings come in line with expectations, and that would be a positive surprise or a positive tail for next year that could drive another good year for markets. On the opposite spectrum, what is also very much not consensus is either inflation surges and the Fed has to raise rates again, pushing us into another bear market, or the economy just collapses and we go into some kind of hard recession. Those are also tail risks for next year that shouldn't be ignored, but I don't think are very high on the likelihood spectrum at this point. And I think that's actually part of why markets are moving higher today, and why I think markets will move higher heading into at least the inauguration into January 20th. I think you could get some volatility around there as tariff policies become real and all of that. But between now and then, one, we don't have a lot of data throughout the rest of this week and next week. Earnings season doesn't really kick off again until about January 15th or so. And we only get so much data even in the second week of January. Most of the data comes out towards the end of January, okay? So between now and really midpoint January, there's not a whole lot that's going to be going on. And I think with the narrative that we currently have of soft landing, good earnings, inflation that kind of trends where it currently is, but doesn't dramatically rise, and a Fed that ultimately cuts rates maybe once or twice next year, is a pretty good backdrop for markets. Now, it's not a great backdrop for big tech. I think it's really a good backdrop for the broadening out trade, especially considering where markets are today. Again, the RSP has fallen a lot. Tax loss harvesting. The winners from the rebound of that tax loss harvesting are going to be value stocks. They're going to be cyclicals. They're going to be small caps, the areas that have sold off the most. And I like that as far as an area to position for into January. I actually think, again, big tech's going to take a back burner and you're going to see a broader market rally, especially if people get more, optimistic about the good side of Trump's policies, like lower corporate tax rates or more M&A activity, less regulation, right? There's definitely a case to be had there that can continue to work for markets. Now, the main reason heading into today, I was calling for a Santa Claus rally, which looks to be actually happening now. One big point here, the percent of stocks trading above their 50-day moving average. If there's one thing that you look at that is your buy or sell indicator, it is this, by far. Okay, 34.19% of stocks are trading above their 50-day moving average. Okay, that means 6% of stocks are in an active downtrend. When you get to the 30s here, when you get into the 30s or the 20s, all you got to do is close your eyes and buy something if you are in a bull market. Okay, unless you've deteriorated, you've went into a bear market or something, then this obviously is not going to work. Like 2022, this did not work. But anytime you get this low, you want to buy something. Now, even in 2022, when we got to these low levels, you ended up seeing bear market rallies. Okay, so it's not like it didn't work entirely. There's just markets ended up going lower following that. Now, the last time we were this low was August 5th, where markets fell almost 10%. And in April of 2024, when markets fell about 7%. Previously to that, you were lower than where we are today back in October, September of 2023, and then back in March of 2023. Before then, you have to go back to 2022, okay? Meaning that in 2024, every time you have gotten to these levels, you have seen a rally afterwards, right? You're just so negative right now that you really don't need much to send markets quite a bit higher. And I think that's where we are now. It's just so negative. You just want to go out and buy something. Now, obviously, I don't know your portfolio. I don't know your financial situation. It's going to vary person by person. But as a general rule of thumb, when you get down to the 30s, the low 30s, as far as the percent of stocks trading above their 50-day moving average, you want to go out and buy something. And especially if it's correlating with other indicators, you really want to go out and buy something like CNN's Fear and Greed Index. Today, it's sitting at 33. That is in the bottom quartile of fear. Okay, yesterday you were at 30, which was even lower than where we are today. But even following today's move higher in markets, you're only up 3 points on CNN's Fear and Greed Index. So definitely a lot of fear from this standpoint. Market momentum is neutral. Stock price strength, extreme fear. Stock price breadth, extreme fear. Put and call options, fear. Market volatility is neutral. Safe haven demand in greed. Junk bond demand also in greed. Now, something else I will point out is anytime the VIX rallies like 60+% in a day, you also want to buy that, right? You also want to close your eyes and just buy, okay? Because unless something dramatically just changed. But that's what happened on the Fed meeting last week. The VIX was up 75% in a single day. The positivity rate a month later is 100% historically. Okay, unless this time is truly different, heading into, let's call it January 18th, you're going to be higher on markets. Question is, how high do we go? How bullish do people get? And that's the ultimate question at this point. But are markets going to do good between now and mid-January? I personally think so. Now, the most recent AI investor sentiment survey as well was on the Fed day. It did not incorporate the sell-off we've seen on December 18th. But it did come in at the lowest level you have seen in all of December, right? Coming in at 40.7% on the bull side, 27.9% on the neutral side, and 31.4% on the bearish side. So definitely likely to see more weakness there in the report that comes out on Thursday. Now, keep in mind, today was a half day of trading. Tomorrow's going to be closed. Thursday's a full day of trading, and Friday's a full day of trading. And honestly, I think at this point, you might start to get some of that buying back of tax loss harvesting in potentially the last 2 days of this trading week, okay? Because, some people tax loss harvest in October, November, okay? So those guys that did that, they've already passed the 30-day window, because when you tax loss harvest a stock, you have to wait 30 days to rebuy that stock. So you actually could start to see more of that rebuying from tax loss harvesting coming even this week. Now, the S&P 500 as well as the RSP are signaling a pretty strong bullish sign here, and that is we just broke back above our 20-day moving average. Now, your 20-day moving average tends to be pretty important for markets. It tends to be either a very strong resistance or very strong kind of rally level, okay? When you hit this on the downside and you find support, that tends to be a really good sign. And you tend to see a lot of activity around this 20-day moving average. Like every time you find support, you tend to rally higher. When you find resistance, you tend to fall further. We just got above the 20-day moving average, and it looks like we could be about to rally further from here. Now, that's just my observation. Obviously, could I be wrong? Yes. Now, on the RSP, things obviously look much worse on the RSP relative to the cap-weighted S&P, but you just broke above your 100-day moving average today at $176.92. The RSP is at $177.58. You pretty solidly broke above that 100-day moving average today. That sets you up to a move to about that 50-day moving average at the bare minimum, likely coming really in the next 2 trading days. By the end of this week, I think you're going to be testing that 50-day moving average. Again, could I be wrong? Of course. That's why you don't want to trade off this information, but I don't think I will be wrong. So that break of the 100-day moving average, a great sign of further strength that likely will come into markets. And I just think about it like this. Did anything really change the outlook, broadly speaking, for 2025? No. The Fed kind of met expectations. Jerome Powell kind of spooked investors with some of the language he used, but bottom line is nothing really changed. Just the markets have gotten more negative. And some of that, again, has to do with tax loss harvesting. Some has to do with, specific large firms situations. Okay. Some firms just had to sell more stock, it seems like, this year for that tax loss harvesting purpose. But either way, whichever way you want to cut it, does not matter. It looks like we got way too bearish, way too fast, right? Percent of stocks above the 50-day moving average, CNN Fear and Greed Index, the breadth of this market. The Dow was down, 12 days in a row? That has not happened since the early 70s. Okay, we had 3 losing streaks, which has not happened, 3 losing week streaks for the Dow, which has not happened also in decades. There is a lot of reasons that we could see a rebound in markets. Okay. And that's really what I'm calling for here into year end. I think people are going to look back and say, did I get too bearish? Did markets get too bearish? Should we be this negative? And I think the answer is clearly probably not. I think the markets are making that decision in real time. So I am optimistic. The rest of this week, really Thursday and Friday, are going to be good trading days. And I really think the start of January is going to be good as well. Heading into at least the inauguration, big bank earnings start off on January 15th. That could get interesting as well, just depending on obviously what they have to say about the consumer. That's going to be important. But some volatility around the inauguration could be expected, really to the upside or the downside. I could see upside volatility coming again because Trump's finally in office, M&A activity, lower corporate taxes, blah, blah, blah. You understand the whole kind of bull thesis there. Also, you have the impact of potential tariffs. We just don't know. There's uncertainty there. Okay, so definitely going to see a little bit more upside or downside volatility in the second half of January. But between now and January 15th, January 18th or so, I don't find the bull thesis that entertaining at this point because, again, we don't have a lot of economic data, and the path of least resistance for markets is most certainly to the upside. So let me know what you guys think about this information down below in the comments section. Ladies and gentlemen, that is going to do it for this video. Have a fantastic rest of your day, and I will see you in the next one.